Berkshire Hathaway Letters to Shareholders, 1965 to 2012, by Warren E. Buffett. Ever wish you could sit down with one of the sharpest minds in business and just talk? No confusing jargon, no fancy formulas, just real wisdom about how wealth actually gets built and what makes companies truly great. Picture this: a friendly, grandfatherly figure pulls up a chair, offers you a warm smile, and says, "Let me tell you what I've learned." That's exactly what we're diving into today. We're cracking open something special, not just a book, but a 50-year masterclass. These are the annual letters written by the man who took a failing, forgotten company and transformed it into one of the most spectacular success stories in history. The man is Warren Buffett, and the company is Berkshire Hathaway. Here's what makes this different from every other business book on the shelf. No ghostwriter polished these words. No marketing team punched them up. Just Warren's clear, honest, and surprisingly funny voice coming through on every page. Since 1965, he's written to his shareholders each year, and this collection has become something of a holy grail for serious investors and business leaders worldwide. It doesn't fly off bookstore shelves because of slick marketing. It spreads through whispers, passed from mentor to student like a secret handed down through generations. Our story begins with a kid from Omaha, Nebraska. No trust fund, no silver spoon, just a fascination with numbers and business that bordered on obsession. While his friends were trading baseball cards, young Warren was delivering newspapers, going door to door selling Coca-Cola, and even buying a pinball machine to install in the local barbershop. His bedtime reading? A book called 1,000 Ways to Make $1,000. Seriously. He eventually studied under Benjamin Graham at Columbia University, the godfather of value investing. Graham's book, The Intelligent Investor, hit Warren like a lightning bolt, giving him what he called a bedrock philosophy on investing that made sense. Armed with Graham's teachings, Warren returned to Omaha and started his own investment partnership. But our real story kicks off in 1965, when he took control of a dying textile company in New Bedford, Massachusetts, called Berkshire Hathaway. It was a terrible business in a dying industry. A single share cost about $18. This is where the legend takes flight. Instead of trying to resurrect the corpse of the textile business, Warren used its tiny trickle of cash to start buying other things. Insurance companies first, then wonderful businesses of all kinds. Fast forward nearly 50 years. That $18 share became worth over $134,000. Yes, you read that right. It became a compounding machine that created almost unbelievable wealth for everyone who trusted him. Today, I'm not just summarizing these letters. I'm your guide through an epic journey. We're not going chronologically, year by boring year. Instead, we're weaving together the timeless principles, fascinating stories, and profound lessons into one flowing narrative. By the time we're done, you'll understand the secrets of the Oracle of Omaha. You'll see the business world not as some intimidating maze, but as a landscape rich with opportunity. And you'll grasp the simple, powerful ideas that can guide you, not just in investing, but in life itself. This is the story of how a dying textile mill became proof that rational thinking, patience, and integrity can change everything. Let's start at the beginning, but not where you'd expect. The Berkshire Hathaway story doesn't open with a brilliant master plan flawlessly executed. It starts with a mistake, a big one. Picture a young, ambitious guy. He's smart, he's studied under the best, and he knows how to spot a bargain. He's looking at a company on its last legs, a textile mill in New England. The year is 1965, and American textiles are getting crushed by overseas competition, where labor costs pennies on the dollar. This company, Berkshire Hathaway, is a shadow of what it once was. Old machinery, tough unions, and a commodity product that's identical to everyone else's. The only way to compete? Cut prices, and that's a race straight to the bottom. So why would our smart young investor buy in? Because it was cheap. The business was selling for less than the value of its assets on paper. It was what he'd later call a cigar butt investment. Imagine spotting a soggy, discarded cigar butt on the sidewalk. It's gross, sure, but there's one puff left in it. You can pick it up, get that free puff, and toss it away. That's what Berkshire looked like. A chance for one last bit of value before moving on. But here comes the first great lesson. Warren learned that time is the friend of a wonderful business, but the enemy of a mediocre one. When you're stuck in a terrible business, every single day brings new problems. It's like quicksand. The more you struggle, the deeper you sink. As he'd later write, in a difficult business, no sooner is one problem solved than another surfaces. Never is there just one cockroach in the kitchen. He spent years trying to make textiles work. He hired the best people, including an honest, hardworking manager named Ken Chase. They tried everything: new products, better machinery, different sales strategies. Nothing worked. They were bailing water from a leaky boat instead of actually sailing anywhere. Warren captured it perfectly. When a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. No amount of genius could fix a fundamentally broken business. This mistake became the greatest gift of his career because it taught him the most important lesson. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But that struggling textile mill did produce a trickle of cash. Not much, but enough. And here's where everything pivots. Instead of throwing that cash back into the dying textile business, which most managers would have done, Warren started looking elsewhere. He began thinking like a capital allocator, not a textile manager. His job was to take whatever money the business generated and move it where it could grow fastest and safest. That search led him to a whole new world: insurance. Now, insurance might sound even duller than textiles, all those contracts and statistics, but Warren saw something most people completely missed. He saw magic in the insurance business model, and that magic has one name: float. What's float? Here's how it works. You run an insurance company. People pay you money today, a premium, for your promise to pay them later if something bad happens. A car accident, a fire, whatever. Between the time you receive that premium and the time you actually have to pay out a claim, you get to hold their money. That pool of money, which technically belongs to your policyholders but that you get to invest for your own benefit, that's float. For a well-run insurance company, this float becomes an extraordinary source of capital. If you're disciplined about the risks you take on, the premiums you collect will cover all eventual claims and operating costs. When that happens, the float is essentially free money. Actually better than free. If you make an underwriting profit, meaning premiums exceed claims and costs, you're actually getting paid to hold other people's money. This was the engine. This discovery transformed Berkshire from a dying textile mill into the most powerful compounding machine the world has ever seen. In 1967, Warren bought a small Omaha insurance company called National Indemnity. It was his first major step into this new world. He'd found his rocket fuel. That little textile mill was now the launch pad, and insurance float was the fuel. With this ever-growing stream of capital from insurance, Warren could put his real genius to work, buying businesses. Not just small pieces through the stock market, but entire companies. He wasn't just picking stocks anymore, he was becoming an owner. And this is where his philosophy truly shines. When Warren looks at buying a stock, he doesn't see a ticker symbol or a flashing number on a screen. He sees a piece of a real business. He asks himself, if I had the money, would I buy the entire company? This mindset changes everything. It forces you to think about long-term economics, not short-term price fluctuations. To help with this, he developed a powerful mental model, an imaginary character he calls Mr. Market. He learned this from Ben Graham. Imagine you're partners in a private business with a guy named Mr. Market. Every single day, without fail, Mr. Market shows up at your door. The thing is, he's kind of manic-depressive. Some days he's over the moon. He sees nothing but sunshine ahead for your business and offers to buy your share at a ridiculously high price. Other days he's plunged into despair, convinced the world is ending, and he offers to sell you his share dirt cheap. Here's the key. You don't have to do anything. You can invite him in, or you can tell him to buzz off until tomorrow. The choice is always yours. Mr. Market is there to serve you, not to guide you. If you let his wild mood swings dictate your own emotions, getting excited when he's euphoric and terrified when he's depressed, you're doomed. But if you have your own solid understanding of what the business is actually worth, you can use his moods to your advantage. Sell to him when he's giddy. Buy from him when he's miserable. This allegory is one of the most powerful ideas in investing. The stock market is Mr. Market. It offers you prices, giving you opportunities. It doesn't tell you the value of a business. You have to figure that out yourself. As Warren says, the market, in the short run, is a voting machine, but in the long run, it is a weighing machine. Over time, it weighs the real substance of a business. So what kind of businesses did Warren hunt for with all this float, all this capital? He'd learned his lesson from textiles. No more cigar butts. He was now hunting for wonderful businesses, and he developed a clear picture of what that meant. A wonderful business has a durable competitive advantage, something Warren calls a moat. Just like a castle is protected by a moat keeping enemies at bay, a great business is protected by something that keeps competitors away and allows it to earn high returns on invested capital. What creates a moat? Maybe a powerful brand people trust, like Coca-Cola. Maybe a cost advantage, like Geico's direct-to-consumer model. Maybe a government-protected franchise, like being the only newspaper in town. The key is durability, something competitors can't easily cross, even with tons of money and ambition. Let's talk about one of the first and best examples, See's Candies. In 1972, Berkshire, through an affiliate, bought See's, a West Coast boxed chocolate company. On paper, it didn't look spectacular. Warren paid $25 million for a company with only about $8 million in tangible assets. Why pay so much more than the asset value? Because he saw the moat. See's had a powerful brand built over decades. People in California didn't just want any chocolates. They wanted See's chocolates specifically. They associated it with quality, tradition, and happy memories. This gave See's pricing power. They could raise prices a bit each year, and people happily paid because they valued the product far more than its cost. This business was a cash machine. Over the years, it's pumped hundreds of millions in profits back to Berkshire, money that was then used to buy other great businesses, and it required almost no additional capital to grow. This is the dream, a business that gushes cash and doesn't need constant reinvestment just to survive. See's taught Warren about the value of intangible assets, the power of a brand. It shifted his focus from balance sheet numbers to the moat around the business. Another great story is Nebraska Furniture Mart in 1983. This wasn't a stock. It was a local, family-owned business in Omaha. Started in 1937 by a Russian immigrant named Rose Blumkin, or Mrs. B, with just $500. By the time Warren bought in, it was doing over $100 million in sales from a single location. How? By following a simple creed: sell cheap and tell the truth. Mrs. B was a force of nature. She bought brilliantly, operated with incredibly low costs, and passed savings on to customers. She ran her business with an owner's mentality, working 7 days a week well into her 90s. Warren saw in her and her family not just a great business, but great management. He bought based on trust. He didn't even ask for an audit. He gave Mrs. B a check. She gave him her word. Deal done. This brings us to another cornerstone of Warren's philosophy: the immense importance of management. The best plans and widest moats are useless without able, trustworthy people at the helm. He looks for managers passionate about their business, who think like owners, and who have a track record of integrity. Once he finds these managers, he does something almost unheard of in corporate America. He leaves them alone. Berkshire's Omaha headquarters is famously tiny. No layers of bureaucracy, no endless meetings, no strategic planning departments firing off directives. He buys great businesses run by great people, then gets out of their way. His job, as he sees it, is to cheer them on and allocate the cash their businesses generate. He once wrote, "I am a one-man compensation committee who determines salaries and incentives for the CEOs of around 40 significant operating businesses." How much time does this take? Virtually none. How many CEOs have voluntarily left us in our 42-year history? Precisely none. This culture of trust and autonomy is a powerful competitive advantage itself. It attracts the best kind of business owners, people who built their company over a lifetime and care deeply about its future. They don't want to sell to private equity that'll load it with debt and flip it, or to a big corporation that'll swallow it whole and destroy its culture. They want a permanent home. Berkshire provides that home. Over the years, cash from insurance and wholly owned businesses like Sears and Nebraska Furniture Mart was used to buy large stakes in some of the world's most wonderful businesses. This is where you see the legendary names: the Washington Post, Geico, Coca-Cola, Gillette, American Express. Each investment tells a story. In 1973, during a bear market, the Washington Post company's stock got crushed. Wall Street was panicking. But Warren, ignoring Mr. Market's depression, looked at the actual business. He saw a dominant newspaper with a powerful franchise, run by a courageous, talented woman named Kay Graham. He knew the business was worth far more than the market price suggested, so he bought big. He wasn't timing the market. He was buying a piece of a great business at a silly price. That investment multiplied many times over. In 1976, Geico, the very company that captivated him as a young student, was on the brink of bankruptcy. Years of mismanagement led to reckless underwriting. The stock, once a Wall Street darling, was now toxic. But Warren looked past the immediate crisis. He understood that the company's fundamental advantage, its low-cost model, remained intact. All it needed was the right management to fix underwriting. A new CEO, Jack Byrne, came in, and Warren, convinced of the turnaround, invested heavily. That investment became a cornerstone of Berkshire's fortune. These stories share a common thread. They're not about complex financial engineering or short-term speculation. They're about a few simple, powerful ideas, applied with discipline and patience over a very long time. First, think of stocks as businesses. Don't get caught up in daily market noise. Focus on the underlying economics of the company. Second, understand your circle of competence. You don't need to be an expert on every industry, but you must know the boundaries of what you understand and stay within them. As Warren says, what counts for most people in investing is not how much they know, but rather how realistically they define what they don't know. Third, demand a margin of safety. This is bedrock. No matter how wonderful a business is, you can always pay too much. A margin of safety means buying significantly below what you believe the intrinsic value is. This provides a cushion against bad luck or judgment errors. Fourth, and perhaps most important, is the power of time and compounding. Warren's success testifies to the magic of long-term compounding. It's not about getting rich quick. It's about getting rich slowly. By consistently earning good returns and reinvesting them, even a small sum can grow into a fortune over a lifetime. He's never been a fan of high trading activity, which he calls, quote, financial flip-flopping. Trading costs are a tax investors impose on themselves. He believes the best holding period for a wonderful business is forever. But his letters aren't just success stories. They're filled with candid discussions of mistakes. He openly talks about the textile folly, about acquisitions that flopped, about great opportunities he missed. He believes admitting mistakes is crucial. He once quoted Robert Benchley, "Having a dog teaches a boy fidelity, perseverance, and to turn around 3 times before lying down." Experience can teach you the wrong lessons sometimes, but by being honest about errors, he builds trust and provides some of the most valuable lessons of all. His letters also contain running critiques of Wall Street and corporate America's follies. He skewers the institutional imperative, the tendency for companies to mindlessly imitate peers, whether making foolish acquisitions or setting outrageous executive pay. He detests accounting tricks to manipulate earnings, famously saying about one metric, "If you hear a manager talk about EBITDA, just substitute the words, bullshit earnings." He detests the short-term focus of most institutional investors, who he sees as traders, not owners. He believes in simplicity, both in business and life. His writing is clear, direct, jargon-free. He uses simple analogies, castles and moats, Mr. Market, cigar butts, to explain profound ideas. He still lives in the house he bought in 1958. He drinks cherry Coke and eats hamburgers. He's a man who achieved almost unimaginable success by sticking to a few simple, timeless principles. And that's the ultimate story these letters tell. It's about rationality in an often irrational world. It's about the importance of patience, discipline, and integrity. It's a reminder that in business, as in life, simple truths are often the most powerful. It's wisdom from a kind, fatherly figure who, through his own journey, has shown us a better way. As we close these letters, what great lessons stay with us? What can someone just starting their journey take from this story? The most powerful lesson, I believe, is about temperament. It's not about having the highest IQ or the most complex financial models. Warren himself has said, "You don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with 130 IQ. What you need is the right temperament. You need emotional discipline to think for yourself, to be fearful when others are greedy, and greedy only when others are fearful. You need patience to wait for the right opportunity and courage to act decisively when it arrives." This philosophy extends beyond investing. It's about making rational decisions in all aspects of life, insulated from the noise and madness of crowds. It's about understanding what you know and what you don't. It's about building your life around people you trust and admire. So what can you do today to start applying these principles? Let me offer a few simple thoughts. First, start saving and start early. The power of compounding is the closest thing to magic you'll ever find. Even a small amount, saved consistently and invested wisely, can grow into a substantial sum over a lifetime. Don't wait. Time is your greatest asset. Second, whenever you think about buying a stock, change your mindset. Don't think of it as a piece of paper you hope to flip for a higher price. Think of it as buying a small piece of a real business. Ask yourself, is this a business I understand? Does it have a long-term competitive advantage? Is it run by people I can trust? Would I be happy owning this for the next 10 years if the stock market closed tomorrow? Third, become a lifelong learner. Read. Read everything you can. Books, annual reports, magazines. Warren spends most of his day reading. Knowledge, like money, compounds over time. The more you learn, the more you earn, not just financially, but in wisdom and understanding. This collection of letters is more than a guide to getting rich. It's a guide to thinking clearly. It's a testament to the idea that success, in the long run, isn't about luck or timing, but about sound principles consistently applied. That was a summary of Berkshire Hathaway Letters to Shareholders by Warren E. Buffett. We've touched on the major themes today, but I'll be honest, a summary can only show you the map. The real treasure is found by exploring the territory yourself. The true magic happens in quiet moments, when one of his stories or a simple turn of phrase connects with you unexpectedly. This summary is meant to give you a glimpse of the wisdom within, to help you decide if this journey is one you want to take. If anything we've talked about today has struck a chord, I encourage you to seek out these letters yourself, because reading them isn't just an education. It's an experience that can genuinely change how you see the world and your place in it. The link to the compilation is in the description. Also, if you found this journey valuable, please show your support by hitting that like button and subscribing to the channel. That way, you won't miss our next exploration into another life-changing book from the billionaire's bookshelf. Let's continue to learn and grow together.